Hey everyone, welcome to Retire with Style. I'm Wade. I'm here with my trusty co host Alex, and it's April 1st, April Fool's Day. So we're here to present you with a very special April Fool's episode of Retire with Style. By popular demand, we're going to have an Alex centric episode. He's our investment guru. And with everything going on in the markets right now, we thought it's really important to just take a step back and think about the role of market volatility in the economy and what it does to portfolios, and also how to think about it as a long term investor. We know a lot of people are concerned about the way things are going in the economy, and to just take a step back and really think about the best way to approach that as a long term investor. And of course, that's an area where Alex has quite a bit of expertise. So he's got a lot to share with us today, Alex. Isn't that right?
Well, yeah, we'll see. We'll see after the episode, Wade. Now, Wade and I have been trying to come up with a good April Fool's joke, and we couldn't come up with one. So the best I could do, Wade, is I'll be April's fool. How's that?
That's right. Yeah, I had all kinds of ideas. And then I just realized right now as we record this, this is actually the episode coming out April 1st. So we didn't get to implement any broad schemes.
It is what it is. The world will have to wait for next year. Right?
That's right. We'll get something good.
All right. But yeah, Wade. Usually, yeah, obviously, it's retire with style, and we like to keep things retirement income centric. But we realize investments play a role in every strategy effectively, and in moments like this, there's always during my professional career, there's probably 3 or 4 events that happen during the year. They're not all equally weighted, but there's definitely 3 or 4 events that happen during the year that always give people pause for concern. And so we think we're going through one of those right now, and we want to address them. Simply put, and not from the standpoint of what's going to happen next, but we've always found that if we break down what's happening right now in a somewhat definitional sense of it, it tends to give folks solace just knowing what's going on. Because I think there's a lot of buzzwords floating around, and sometimes we take a lot of things for granted and they begin to escalate on themselves. And so we just naturally feel knowledge is always a good thing to sort of level set.
Absolutely. And as we get started on this today, this was kind of because of what's going on in the markets, not a lot of planning in advance, but you're doing a webinar today for the retirement researcher and McLean Asset Management and the broader Retire with Style community. Because we didn't have really advance notice on doing that, it's too late to actually see the live webinar. But if you do want to see the visuals and along with the content Alex is describing today, we'll have a link in the show notes, and we'll make the recording available through
That,
Retirement Researcher.
that's a great point. Yes, we are releasing this podcast on Tuesday, April 1st, and we are also having a live webinar on Retirement Researcher for all of our members and the like. And so we're going to be speaking about a lot of concepts today. So if this is something of interest, yeah, feel free to on the show notes. We'll have a link for the webinar directly where you can see it, and some of the concepts will have corresponding charts. Which during this podcast, because this is an audio version, it's more difficult to do the imagine a chart that does this.
Right,
So
right. With investing, it's
yeah,
nice to
yeah.
look
So
at historical data.
exactly. So knock yourself out if you want to see it live. I'm not live, but if you want to see a recorded version.
I think that's the big call to action for the week. It's too late to promote the webinar, but you can catch the recording to provide the visuals alongside what Alex is discussing. And in that regard, let's dig into things. So, Alex, market volatility. What is that all about? Why is this something we should be thinking about? What is market volatility?
Well, volatility is when you're doing a financial plan. That's when you put in the standard deviation, effectively the dispersion of those returns. But from the standpoint of CNBC and volatility and what's going on around that, that's described as a lot of times periods of significant unpredictable price movements in the financial markets. Wade and I wholeheartedly believe a lot of the information that's out there is priced in the markets, gets digested effectively instantly, and it's priced within the market. And so there's quote unquote, let's say, reasonable bets placed upon that information. But extreme periods of volatility occur when new information is coming out very frequently, and expecting new information coming out, not knowing exactly the signal behind that, leads to a lot of price fluctuations around that. Now, volatile markets can stem from a variety of sources, Wade. I mean, it's economic considerations, government policies, global events, and right now, what you're seeing is a bit of a trifecta on all of those things.
Mm-hmm. So one other thing too is just market volatility works in both directions. If
Yes.
markets are increasing rapidly, that's volatility, but that's not something anyone's complaining about. So really, we're thinking about market volatility when it's particularly showing volatility in the downward direction.
Yeah, but what I would add to that though, you see a lot of volatility. They're like grapes, right? Up and down. They come in bunches, and so the down and up days are very, sometimes closely linked. But
Right.
I'm not providing strong data behind that right now. But that's what you kind of see.
Yeah. I mean, some days market fluctuations are maybe 0.3 up, 0.2 down, but then you get into periods where suddenly each day there's more than a 1% movement.
Yeah,
And that
exactly.
can be concerning.
Now,
But
you've said a lot of times, Wade, and I'll put it to you. What Because we do the accumulation stage and the distribution phase. How would you describe market volatility, at least on a little bit of the downside, for an investor who's in the accumulation phase versus an investor who's in the distribution phase?
yeah, I think that's important. I've heard like a lot of different slogans. I think one of the most creative ones was when you're accumulating, it's dollar cost averaging. When you're taking distributions, it's dollar cost ravaging. It's the idea that if you're saving for retirement, market downturns in the long term can be helpful just because they let your new savings get to buy more shares for the same amount of funds that you're investing. But that kind of idea reverses post-retirement, where if you need to take distributions to meet a fixed amount of spending, if there's a market downturn, you have to sell more shares. And that's the whole idea of the sequence of returns risk, where if you have to sell more shares, even if the market subsequently recovers, your portfolio doesn't enjoy that full recovery. So retirees do become more vulnerable to market volatility than pre-retirees.
Okay.
Yeah. Now, when we talk about volatility, there's the VIX measure. Could you talk a little bit about what that is and why? I know even on my computer, I never asked it to tell me VIX, but in the lower corner, it's always giving me updates on what's happening with VIX. I don't know why, but can you
That
tell us what
that's
that's all
that's
about?
your agreement that you made with Bill Gates in your operating
I
system.
guess so. Yeah.
But yeah, you hear this a lot. The VIX index, the fear index, and think about it. If you're a news station, it's kind of a nice thing to say, the fear index, because that's gonna get eyeballs on the screen, right? But effectively, volatility is, again, for financial planning purposes, it's measured with metrics like standard deviation, measures of central tendency, right? How far are you from that central tendency? And that tends to be a standard deviation. But within the financial space, on the floor of the exchanges and things like that, almost like a sentiment tool, you see what's known as the volatility index, the VIX. And that's calculated in real time by the Chicago Board of Exchange. And what it is, it's trying to give you markets expectations for volatilities over the next 30 days, right? Options are priced. Part of the option pricing model is to include a volatility measure, right? And so, leave it to the Chicago Board of Exchange to come up with one. But effectively, it's the market's expectations for volatility up or down over the next 30 days. And it's commonly referred to the fear index because it typically has this inverse relationship with market prices. If the fear index goes up, that's usually because the market prices have been going down. And when markets go up, there's less of a fear component to it. So you see the index go down. But you see that being talked a lot about in terms of what's going on. They're trying to blend, if you will, the actual movements of the market again with what they think is going to happen within the next 30 days from a total price movement, but it's using, to some extent, historical returns to begin to interpolate the next 30 days. And so it's come hand in hand. it's come hand in hand with sort of the investment media, sort of the VIX as this sort of volatility measure from an expectation standpoint.
Yeah, and just to kind of clarify the point that you made, like with these alerts that I mentioned, it shows me for different market indices and for the VIX. And usually green means up, red means down. So usually you like to see green on those market alerts. But the VIX, if you see green, like up 8%, that means all those indices are probably going down because of that fear index. When the VIX is up, probably means markets
It's
are
funny,
going
way
down.
because if you're south of the equator, it's the opposite.
Right. But if you see the VIX is red down 8%, you might panic. Oh no, the market's down 8%. No, that probably means the market's going up. So
Yeah, it shows you how little we actually follow it. I personally don't. I mean, I look at it just to kind of know from the standpoint of what our clients may be being exposed to, but I'm not like religious
well,
about it or anything like that.
and like I was saying, the only reason I know is for whatever reason I get these alerts in the corner of my screen. I could probably turn them off, but that sounds too complicated.
That's because you're
So
messing around with a new AI imaging tool. You don't have time for that. You don't have time for that right now.
yeah, so as you were preparing for that webinar, you uncovered some interesting data from the Dow Jones Industrial Average, which I know you've talked in past episodes really is not a meaningful index to understand market movements, but nonetheless, it has the data. So
Yeah, there's data's there and it's presented, and so I'm trying to put myself into in the standpoint of the individual consumer, the individual investor, right? And so you just get bombarded with the Dow Jones, and so in line with the VIX, which is this fear index, I think people right now, especially, they're probably looking at the markets on a daily basis or multiple times a day, kind of thing. And I want to point out is there any signal to be had? Because it's very easy to look at it last week and think, oh, okay, the market's doing well today. All right, I can now shape my day accordingly. Oh, the market's doing poor today. Okay, I can now worry more accordingly, right? And so I want to kind of convey the sense of, is that worth the calories? Is it worth the mental calories? And I think everyone can already know where we're going with this, that it's not. But I just want to add to this because I think it's quite interesting. So we took over a 10-year period from 2015 to 2025, right? Right now. And right now being when we're recording this, probably a few days ago, we're recording this on the 27th. So I think I did this on the 25th. All right. The Dow Jones has returned January 2015 to 2025, 24,467 points, right? Roughly speaking, it's really 0.28 at the end, but 24,467 points. It's gone up since that period of time. And think about everything we've gone through in that period as well. But for that return, what we also did is we wanted to look at the absolute number of points it traversed to be able to achieve that 24,000 points. So, for instance, if it goes up 300 points today, that's 300 points. If it goes down 300 points tomorrow, that's 300 points, right? And so that's 600 total points for a net of 0. All right. So I wanted to see if it's worth following. What happens if we follow the up days and the down days and the sort of the emotional roller coaster that entails. So to get to that 24,000, roughly 24,500 points, the Dow Jones needed to move 491,000 points. So think about that. 24,500 points net. You needed to move 491,000 points. So said another way, for every point that the Dow Jones moved up, you needed to go through 20 points in absolute terms.
mm-hmm.
It's a waste of time. And it's just an aggravation to try to find signal. And so there's plenty of people that are like, oh, it's been up 3 days. Okay, that's going to portend good things over the long term because, we had a run of bad returns. Now it's been up 3 or 4 days. We're good. And you see this all the time on CNBC. Oh, the market has a string of 6 weeks of positive returns. Are we going to break that streak? I mean, the answer is who cares, ultimately. It doesn't mean anything. Remember, for every 1 point that goes up, it goes down accordingly, right? In fact, you need to get 20 total points to net up 1. It's just a waste of time. I mean, what are your thoughts around that, Wade?
Well, yeah, it just speaks to the whole idea of you don't need to watch daily market fluctuations. And then that usually gets accompanied with the idea that people are loss averse. And so the pain of seeing the downturns more than exceeds the happiness of seeing the upswings. And so when you have to endure that much volatility to see each positive upward movement, there's going to be a lot of aggravation for
Yeah,
sure. So it's
exactly. You really talk about like a high maintenance relationship. You have to go through 20 points of highs and lows to net 1 point. You're better off just sticking to the NCAA tournament and calling it a day at that point.
way to be
But
topical with your
that's kind
references.
of an interesting thing there. I'm sorry,
How
Wade.
about that local sports team?
Yeah, exactly.
Okay, so markets have been exhibiting some volatility, not necessarily one of the biggest swings. We did hit historical highs mid-February. We're still at this point. International markets are up about 8% for the year, but US markets are down. The S&P 500 in the ballpark of 3% down. The broader total US market, a little more than that, maybe 3.5% down. What's causing that? Like what is the news that we're getting that's leading to this kind of volatility?
Yeah, and again, this is what we're going to talk about. Is not because we have an opinion one way or the other. I mean, we all have personal opinions, but I mean, from a professional standpoint, being a McLean Asset Management is based effectively in Greater DC. We've become experts at being like politically agnostic ninjas, if you will, or shinobis. Wade, you spend time in Japan, right? And so, from that standpoint, I don't want anyone to read what we're going to say has some political inclination one way or the other. All we were trying to do here is define the terms that are happening, right? Just because, again, we think that helps level set what's going on. All right, and I think there are effectively four horsemen right now that are leading the way towards this market uncertainty because you're seeing news coming in every day, and people are having trouble knowing what's going to be the next day's news cycle, right? But effectively, you see tariff wars, inflation, the tech sector, the Mag 7 or whatever, they're having their comeuppance a little bit, and policy government spending as, the current president is implementing policies, if you will, or trying to implement policies, if you will. The first one being like we can take the tariff wars, right? And in general, some of you may know this, and we're not. Each of these can be podcast arcs, so we realize we're not giving each one its treatment, but we just want to kind of do the Wikipedia version, if you will. In terms of tariffs, you have what is a tariff? Tariff is effectively a duty or tax imposed by the government of a country on imported or exported goods. The purpose is they want to regulate trade balance, if you will, right? The U.S. being a consumer-driven nation in which we're actually net importers of things because our consumption is so high, and what we export may be tariffed a little bit more than what we import. There's this desire to maybe balance that out a little bit, right? And in addition, maybe able to generate revenues. Now, effectively, it's not just a clean slate of, generate revenues and why not, right? More revenues is better than no revenue, right? But there are impacts that has effectively. If you impose a duty where you bring something over and you're gonna today it came out that Trump yesterday announced there's going to be a 25% tariff on automobiles, right? Well, Mercedes, are they going to eat those 25% increase? Most likely not. Most likely they're going to pass it on to consumers, if
And
you will.
that's an important point that back in the days when I taught introductory economics, we talk about the economic incidence of the tax versus the legal incidence of the tax. And so legally, whoever the actor is that has to pay the tariff, well, they pay the tariff, but economic incidence gets into like who's really paying. And that depends on the elasticity of supply and demand. It's just who's the most sensitive to price fluctuations. You really have to look on a case by case basis. But the point you just made, yes, in many cases, though technically the producer or whoever the actor is that has to pay the tariff, Well, if they just adjust the price upward that they charge because they know they can pass that cost on, they don't have the economic incidence of the tariff. It's if I increase the price by the amount of the tariff, it's the consumer who ends up paying for the tariff. And that's where we do just have to tease out in each particular case. It's not obvious just on face value who's really paying for the tariffs.
Yeah, and I'll add to that. I mean, I made a broad statement saying that we're generally net importers because of our consumption, right? But some industries we may not be. We aren't. If you take it industry by industry, it may hurt certain industries more than not, such as the agricultural industry, the semiconductor industry, the consumer goods industry. If there's broad blanket tariffs, some industries may benefit, some industries may not. The consumers in the U.S. may get hurt more than a consumer in another country for a particular type of industry. So it's a little bit of a balancing act there. Like I said, this would be its own arc in and of itself, but that's really generally what you're seeing. And ultimately, I there was something as I was gearing up for the webinar. I didn't realize this way, but tariffs were a huge revenue source for the U.S. This is before World War II, even, kind of thing. I had no idea. Now I think it's like 2%.
Yeah, we now have income taxes that play the role, but income taxes did not exist for much. I think what amendment was it around the 1910 period that we?
If I wasn't aware of the tariff, how am I going to know what amendment? But the point is, it's kind of it's not this brand new tool. Now, if you ask, just on a personal standpoint, it seems to be more of a negotiating tool to try to balance out, if you will, the trading between partners. And frankly, when you're staring down a multiple $1 trillion deficit, it's very easy to say, hey, why don't we begin to use this arrow in the quiver? But again, there's significant knock-on effects, such as, is this particular industry within the U.S., whether are they able to weather the economic disruption caused by the tariff? And frankly, if there's all of a sudden there's a slowdown in imports that are needed to produce things here, does that affect the supply chain, right? Is there a domestic resource available that we can use instead that nets positive for us? And is it a short-term thing or is it a long-term thing? Is it a long-term thing? Well, what's the adaptability for us to really, create these supply chain efficiencies within our own country that we're not necessitating, things to come in, if you will. There's a whole set of knock-on effects, but ultimately, what you get down to it, if you talk about a schoolyard kind of thing as a negotiating play, it's like if Wade and I get into a fist fight, which happens on occasion. No, if Wade and I get into a fist fight and Wade wins, right? But he has a black eye and a broken nose, and his wife asks him, hey, what the heck just happened to you? And Wade says, I got in a fight, but you should see Alex. I won. You should see Alex, kind of thing. Right? It's one of those things where you're going to get bludgeoned. You may win, but what's the net here, right? Wade, what do you think of that analogy? Did you learn that in economics class?
Both sides get hurt.
Yeah, both sides get hurt. Ultimately, I think Trump is banking on, we're a consumption-driven country more than anything, and they need us more than we need them. And that may be true in aggregate, but industries may suffer because they're not all equally weighted within the U.S. in terms of net importer or exporter.
Winners and losers for any kind of tax. And yes, the income tax was the 16th Amendment ratified in 1913. And so tariffs since then haven't really been used as big revenue generators for the federal government. But before that, it was one of the primary revenue generators.
And so that's what you're hearing in the news, tariffs. Now, why tariffs? Who cares? Well, that could lead to stagflation. And in its basic sense, it's effectively economic growth is down. Inflation is still high for us on a historical basis. Inflation is still high. So if you have slower economic growth, inflation is high. Slower economic growth may lead to higher unemployment. That's a recipe for stagflation, which is effectively high inflation and slow receding or stagnant economic growth, and you get the triple whammy of high employment. That's really the concern that the markets are saying, and they're trying to price that right now. They're trying to price that. And it's a difficult thing to price because there's new news on the tariffs. Because I think it's a negotiation ploy. So they're like changing the lines in the sand on a every other day basis right now. And so I think that's enough about tariffs, right, Wade? There are enough that we want to get into for the purposes of this.
Yeah, let's move on to inflation. I think that was your next horseman of
Yeah,
the.
and why don't you talk a little about inflation, since this is something that we're coming off of retirement income challenge where we did a financial planning, we did a lot of funded ratios for folks, and inflation was kind of like front and center since that tends to be our discounting tool on that.
Yeah. So for quite a while we had low inflation that we talked about, like the Federal Reserve targeting somewhere in the ballpark of a 2% annual inflation rate. And we had been below that for quite a while, and then going into 2021, 2022, we did see inflation picking up, hitting that 7, 8, 9% range. And then since then coming back down again. I think it was 2.9% was the finalized number for inflation in 2024. It's still, each month we get the new updated annual number that just takes the old, the last month from the beginning of the year, cuts that out, adds a new month in. I think we're still now at this point somewhere around 3% as an annual inflation rate over the previous 12 months. That's the general rise in prices for a basket of goods purchased by the typical American consumer. And the government does like to have some positive inflation just to create more flexibility with managing real wages and things. Deflation can be very harmful when price levels are actually decreasing. So we do want to see positive inflation, but certainly once it starts getting above that 2 to 3% range, it creates a lot of concern. And the Federal Reserve is very focused on managing monetary policy to keep the inflation rate under control and as close to that 2% target as they can.
Yeah, so effectively, tariffs, right? The uncertainty around tariffs, inflation is still high on a relative basis, right? Relative to what we have, and there's some areas that are quite expensive. It always makes the news, right? What was it, eggs last month? There's always things that you're like, oh my goodness, right? And so you have that. Then you have the weak technology sector return being that third horseman, if you will. And currently, remember, technology is, it's almost not even a sector soon enough because it's just all encompassing across all industries. But the high level technology stocks that we think in our head, they represent about 30% of the index. And right now, only about 30 out of 100 of those holdings are in the positive. Year to date, I believe, as of the 24th, they were down 7.5%. Which brought down the entire S&P as of the 24th to negative 2 and change in the low range, 2.1 or something like that. And so that's just going to drag down the folks. That's just going to drag down the market right now. So again, tariff, inflation still on the higher side, and technology is kind of waning a little bit. Now, we talked about this when we did our quarterly review in the last podcast about international investing. The good news is international stocks are up 6.6% year to date as of the 24th. I don't know what it is today, whatnot. So again, I'm throwing that out there from a diversification standpoint, right? Highlighting the importance of diversification. But nonetheless, the tech sector is being a significant drag. As much as it was a great return on the upside, it's a significant drag right now.
Yeah, and if you have a globally diversified portfolio, year to date, you might not even see losses. I guess depends what it does Friday and Monday before the episode airs. But as of the recording date, you're probably up for the year.
100%. Now, the last horseman is that government spending and budget cuts, right, leading to volatility. So you think of what we did before, and I guess tariffs is related to this because it's a government policy, but not government spending, and I'm specifically relating to the government budget cuts, where again they're trying to address the deficit. Rightly or wrongly, I'm not here to make a position in regards to that. I'm just kind of like trying to dragnet this and say just the facts, right? And okay, we talked about the issue of tariffs, why they're used. What's the idea behind the government spending and budget cuts? Again, it's reducing the deficit right now. Multiple trillion-dollar deficit in which, they're drawing a line in the sand saying, okay, we're going to address this come hell or high water. And effectively, they're They're taking a look internally and making significant cuts to government services right now. And ultimately, I'm in Greater DC, so the reality is there's a lot of folks that I'm like 1 degree of separation with that are, selling their houses now because effectively they don't, they've been told, they're not going to have a job in a week and so forth. So there's a lot of anecdotal stuff, but that's just in this area, Northern Virginia. But what you're seeing a lot of is there's a lot of government contractors. There's a lot of, knock-on effects where people have 1, 2, 3 degrees of separation from some sort of government agency that's being significantly affected. I mean, the news came out last week about Accenture, right? And so there's this who's next on the chopping blocks uncertainty. And what ultimately you start seeing this reduction in consumer spending. And not only that, cuts in social programs may disproportionately affect a more most common denominator household, reducing overall demand, if you will. Wait.
Yeah, just with households that tend to spend a higher percentage of their income are gonna, if their income goes down, they'll spend less. So yeah, less consumer demand.
Exactly. On a proportionate basis, if government spending is cut and that's part of your, a higher proportion of your income that comes from that, then obviously it's going to have knock-on effects on how you spend that money, such as the corner grocery store, et cetera, et cetera. Now, so just to put it quickly in perspective, you have this volatility right now because of the uncertainty around the tariff wars. High inflation is not an uncertainty. It's just a thing that you see right now. And we're still trying to, bring it down, right? But tariff wars, what's going on with the technology sector and this monetary policy and government spending. You have news coming out almost on a daily basis on those things. And the news isn't trending one way or the other. It's either course correct, U-turn, left turn, right turn, straight ahead, that kind of thing. And so it's hard for the markets to digest all of that and feel confident that they've got a beat on this from one day to the next. And so you see that. Now, what you have to ask yourself, is this new? Does this happen all the time? And the reality is, this is the risk you take for investing. Right? People say investing in the market, it's risky. It's not risky from a standard deviation standpoint, but it's risky from I don't know what's going to happen standpoint. Because, I mean, let's start in you have this all the time. I mean, in the 70s, you had the Arab oil embargoes. In the early 80s, remember, inflation was 13.5%. In 1987, you had Black Monday. I think it was the single biggest drop in the market on a percentage basis, 23%. You had the Iraq invades Kuwait. You had effectively the Russian and Asian crisis is right around the internet bubble, right around there. I don't know if people remember, but remember Y2K? I don't know how old you are. Y2K was like planes were going to fall out of the air because the 1 and 0 binary codes were going to cause this huge rigmarole, if you will.
Yeah, I thought the dates were only 2 years, and so all the computers are going to think it's 1900 again or something.
Yeah, exactly. Should we have flights in the air at that point? You had the 9/11 attacks, you had the dot-com crash, and then the whole Enron corporate malfeasance thing. You can go on and on. I mean, in 2008, during the subprime mortgage crisis, the market, the U.S. market dropped 46%. You had I can go on and on in terms of the specifics. We haven't even touched upon COVID and how the U.S. was shut down for 2 years. And so in the grand scheme of things, what's happening right now, I think it's a walk in the park, frankly, me personally, on a relative basis, based on the stuff that we've just gone over. Wade, what do you think?
Yeah, well, you may not even have a loss for the year at this point. So.
Yeah, exactly.
So, yeah.
Exactly. And so that I'm not minimizing what's happening right now. I'm just trying to put it in perspective relative to investing in the market is about uncertainty. And I'm not even saying you should suck it up, buttercup, and remain invested. I'm just sort of saying this is par for the course when it comes to markets and investing in the markets. And if you can't get beyond this, then the answer isn't suck it up, buttercup. The answer is find a strategy that you frankly feel comfortable with, which is the whole reason that we had the RISA. Remember, retirement income planning isn't about total return and making someone deal, take a sustainable withdrawal rate, and you know what, suck it up if markets are tough. No, it's really about finding how you want to source retirement income in a manner that suits your preferences. Wade, do you have anything to add around that?
Well, yeah, I mean, that's the RISA. Great summary. But yeah, that's the whole idea. Investments are going to have a role to play in any retirement income strategy. If your total return, you're like this whole idea of just stay the course. Hopefully that resonates better with you. If and the way to make that resonate better for you if you have a different style is to just make sure you have sufficient reliable income so that you know your essentials are always going to be covered. That can make it easier to then endure the market volatility that the investment piece creates in the short run to hopefully then see those greater long-term returns.
Yeah. And so now someone can say, yeah, but look, if I can I get over the long term, we'll be fine. But you know what? There's trading opportunities here. Let me jump in on this. I would say not so fast, simply because, there's charts that are out there, right? And you see this all the time. And this is where there's kind of a cute phrase that says, it's not about timing the market. Investment success is about time in the market. You get it, Wade?
Yeah.
See what we did there?
Let's do all those cliches.
Yeah. No,
Time in the
you see that
market,
all the
not
time,
time
right?
in the market.
And so if you take like the world index, the world global market, Morgan Stanley, blah 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 blah, the world market, from 2001 to 2024, the full period returned 6.5%. If you missed the best 100 days of that time period, which is about, I just did 250 times 25 years because I didn't want to count. Effectively, if you miss the best 100 days, it's 6.5% down. You're down 6.5%.
Annualized. So
yeah, annualized. I'm sorry. If you missed it's even worse. If you missed the best 50 days, you're down still about 1.5%. If you missed the best 15 days, you're up 2.8%. If you missed the best 5 days, you're up 5%, effectively 4.9%. So annualized, that's a lot over 25 years, and so you want to get the full rack of 6.5%, and you do that by just being invested. You don't miss out, right? Now, someone can say naturally, what happens if you miss the worst day, right? What happens if you miss the 5 worst days because you were out of it? Look, at the end of the day, it nets positive, so you're better off just getting the whole menu of items, right? You're better off capturing the entirety of the return. Because if you really think about it, there are about 6,500 days in that period. How in the hell are you going to pick knowingly the 5 worst days to miss? You have to be beyond lucky from that standpoint. You're not smart enough to do it. You're really not. You may think you are, but you're not. No one is. No one is able to do that. And I think you need that humility to recognize that. And the humility to recognize that comes from the standpoint of, I'm just going to capture the market rates of return. When you think you can time this, you're really doing yourself a disservice because you cannot. Wade?
No, I mean, that's absolutely right. And like you were saying before, too, not that this is any predictive power, but often the biggest gains happen shortly after the biggest losses. And so if those losses scare you, then you've completely missed out on where those gains might tend to more likely happen. Not that that's anything predictive there, but
but you kind of see that because the VIX is high. That's when things go up and down. But look, another way of doing this is you want to give yourself a chance of what's going on, right? Let's just look at the probability of returns, right? In any given year, the markets have gone up 53% and gone down, and the markets can go have gone up 53% of the time. That means they've gone down 44% of the time, right? That kind of thing. But over time, if you give yourself sort of this sort of time, what about every 3 years? What about every 5 years? What about every 10 years? What you find is that your market over a 10-year period, the best return was 16.8%. The worst return was -5% over a 10-year period. But through time diversification, again, over a 20-year period, the best 20-year periods was 14.4%. You have to be lucky to get in that. The worst was -1.9%, right? You can play your odds, but the point is the dispersion of the returns tend to kind of close over the longer time period, and you're most likely to have a higher return than a negative return the longer you're invested.
Yeah. Over
That,
a year, the stocks historically have gone up maybe it's over 70% of the time over 1 year periods. But as
I
you look
said it
at,
the wrong way actually. The best 1 year return was 53%. The worst 1 year return was 44%. My bad.
but
Yeah.
yeah, about
And
two
so what
thirds
you
plus, 70% plus. But then as you look at longer horizons, the probability of having, historically speaking, higher positive returns over longer holding periods goes up and will eventually get to 100% historically.
Yeah. And so what you want to do in moments like this, what I find myself, my go-to thing is you take a little page out of psychology, right? And how do you deal with stressful moments and making decisions during stressful moments? And ultimately, you want to ask yourself, a few questions. And it's really 4 questions, Wade. And this is where you use the concept of your future self. And I'll ask it for you, Wade. Uh, is getting out of the market now a good decision based on the next 10 minutes? 10 minutes from now, will I regret this decision, getting out of the market? If not 11 minutes, I mean 10 minutes. You're going to die in 10 minutes, kind of thing. Would it have been a good decision to just get out of the market?
I'm, well, I don't understand the question.
All right.
I'm
All right.
going to die in 10 minutes. Should I get out of the market before
No.
then? Or?
Like 10 minutes from now, will you have regretted getting out of the market?
Oh, it probably depends on what the market
Yeah,
does in the
maybe,
next
maybe
10
not.
minutes.
Who knows, right? Will you have regretted getting out of the markets 10 minutes from now?
It's going to be a
The
big
answer
tax
is,
bill.
yeah, maybe not. Would you have regretted getting out of the market 10 days from now?
Oh, yeah. I mean, as we look at longer
Yeah,
horizons, you're going to increasingly probably regret things.
yeah.
Yeah.
Are you going to regret this 10 months from now? Are you going to regret it
Probably.
10 years from now?
Almost surely. Yeah.
Yeah. And it's not and it's a cop out if somebody is listening and telling themselves, no, but I'll get back in before then. Wade wants to keep this podcast rated PG, so I won't say that's beep. You know what I mean? The reality is you're even ruining your odds for success doing that, because you have to be right getting out and you have to be right getting in. And let's say at best it's a 50% chance, each time. So cumulatively, you're giving yourself a 25% chance to make the right decision. Why in the hell would you do that to yourself? You're not smart enough to be able to do that. I'm not. No one is. When I say you're not, I mean like no one is. So why would you give yourself that kind of thing?
And it's not intelligence. It's just we don't know
Yeah,
all the news.
exactly.
All the information we have is priced in. So it's randomness of what happens next that's going to
Yeah,
impact things.
exactly. The other piece is, but wait, Alex, everyone knows the market will tank. Look at the sentiment indexes. They're companies that ask investors, how good do you feel about the market? Are you bearish or bullish? And CNBC does this all the time. These market sentiments. Now, if you divide sentiment analysis in quartiles, like the most bearish, the most bullish, right? Wait, when do you think you see the most positive returns? As in greater than 20%. The market returns greater than 20%. When do you kind of see that? When people are the most bearish or when people are the most bullish?
Well, I'm looking at the chart, but I could have predicted this. That
Yeah,
it's when sentiment is most bearish that's ultimately because of the recency bias. Returns may have been bad recently, leading to that bearishness. But then that's when returns will tend to be better subsequently. And conversely, people are probably most bullish after the market's been doing really well, and things
yeah.
can't just go up forever. So that would tend to be the time that you may
What,
see lower subsequent
what
returns.
you see is, and this is from 1987 to 2024, when people were the most bearish on a quartile basis, the market return greater than 20%, 36% of the time. When people were the most bullish, the market return greater than 20%, 17% of the time. And it's a linear decrease, dividing this into quartiles, right? When you see this all the time. And so it's one of those that you want to make sure that you kind of disabuse yourself from listening to that kind of stuff.
It's the same kind of plot as that old Dunning-Kruger effect of.
Yeah, 100%. You're 100% correct. I mean, I don't want to say when people, but there's a flip side to this. I don't want people to think, oh, but when people are the most bullish, we should get out of the market, right? Because there's still a positive return. When the people are the most bullish based on quartiles,
Yeah.
the market still returns about 6.5%.
Yeah, and going to the other end of that distribution too, like when people are the most bearish, 20% of the time subsequently market returns are negative. When people are most bullish, subsequently 25% of the time markets had negative returns. So it's not that big a difference, but it's there. The markets tend to have the least likelihood to fall when people are most bearish.
Yeah.
Not
And
a big
so,
difference, but still it is. It's
yeah.
counterintuitive in that regard.
And so here for me, it's the focusing on what you can control. Look, we're not going to be able to control right now the four horsemen that we said: the tariffs, the inflation, what's going on with the tech sector, and and the like. We just it's a bit of tougher and monetary policy and government spending. You know, the spending cuts. We can't control it. But what can we control, Wade, when it comes to investing? You know, from the accumulation side and from the retirement distribution side.
Well, you can control your asset allocation choice, the strategic asset allocation, cost of your investments, the time horizon that those investments before you need them to spend. You're managing emotions around that, using tax efficient distributions, so managing the tax side of things, and just taking valuations into consideration.
Yeah, from the strategic allocation cost for it. But yeah, effectively focus on what you can control: the risk you're bearing, the cost that you're spending for implementing the strategy, the time, the emotional energy spent for this, and taxes. I mean, at the end of the day, it seems maybe trite, but it's the truth. It doesn't make it any less right. And so we wanted to take a moment to just review this and level set. Listen, this is what's happening. Not because we're making forecasts around it, but I do feel from my experience, just discussing what's happening in a manner that's not politically charged or as least emotionally charged as possible. I mean, helps people just simply understand, oh, okay, I see the concepts that are effectively influencing the market right now. What are those concepts? What could happen? What could not happen? Just because I think knowledge is power in that sense. But then take a step back. We've seen things like this before at significantly greater scale. And at the end of the day, what happens to the market? What happens to the markets? Bad days, good days. What's the net on those, etc. And what can we do about it? And there it is, Wade. If you want to see this in greater detail, we will be talking about this in greater detail in a webinar. It'll be recorded in the show notes. Feel free to knock yourself out. But Wade, we have a Q&A, you said?
Yeah. Now, this question I pulled out for the week is somewhat lengthy, and unfortunately, I do have a hard stop coming up here on the recording time. But let me pull the last part of the question, and then we could consider. It's actually a multi-question question, so I'm just going to take one of these for now, and we'll leave the rest for another time. This is on the topic of doing Roth conversions, and the scenario here is you've got your IRA, your tax deferred account, and you have your Roth account, and you're thinking about covering your spending needs. You're thinking about doing Roth conversions. So again, there were multi-parts to this question, but let me just ask the last one because it's a pretty quick one. Does the math ever work out to cover your spending from the Roth in order to do more Roth conversions? Or is that just taking from one pocket and moving to the other? And the answer to that is you had the right intuition there, that would just be taking from one pocket to move into the other. If you're gonna meet your spending through Roth distributions so that you can Roth convert more money into the Roth, you haven't done anything different than if you just had covered your spending through the tax deferred account. So no, in this context, you would not cover your spending goals through Roth distributions to make it possible to do more Roth conversions. That wouldn't impact the overall amounts you had in your IRA and your Roth IRA in that scenario.
To Roth or not to Roth?
To Roth or not to Roth? And there were more parts of that question, but we'll save those for another time. And we'll thank everyone for listening and catch everyone next week for another episode of Retire with Style.
Bye, everyone.